Assalamualaikum warahmatullahi wabarakatuh. My name is Puspita Dewi. I am from class Accounting B. Accounting principles. What are accounting principles? Accounting principles are the general rule and guidelines that companies are required to follow when reporting all account and financial data. Maintain and manage your business practice with Debitor, online accounting platform to help you stay on top of your financial reporting. Whilst there is certainly no universally standardized accepted accounting principle, there are various accounting frameworks which set the standard body. The most common accounting principle framework used are IFRS, UK-GAAP, and US GAAP. There are both similarities and differences between those three frameworks, where GAAP is more rule-based, while IFRS is more principle-based. Why are accounting principles important? The purpose of having and following accounting principles is to be able to communicate economic information in a language that is acceptable and understandable from one business to another. Companies that release their financial information to the public are required to follow this principle in preparation of their statement. Depending on the characteristic of company or entity, the company law and other regulations determine which accounting principle they are required to apply. The standard accounting principles are collectively known as General Accepted Accounting Principle or GAAP. GAAP provides the framework foundation of accounting standard, concept, objective and convention for companies, serving as a guide of how to prepare and present financial statements. Why are generally accepted accounting principles needed? GAAP aim to regulate and standardize accountancy practices by providing a framework to ensure companies and organizations are transparent and honest in their financial reporting. Accounting principles serve as a doctrine for accounting theory and procedure in doing their accounting system. Accounting principles ensure the companies follow certain standards of accounting how economic events shall be recorded and present. External stakeholders, or for example investors, banks, agencies, etc., rely on this principle to trust a company is providing accurate and relevant information in their financial statement. Example of accounting principles. There are some of the main accounting principles and guidelines listed under US GAAP. Conservative principle. In situations where there are two example solutions for reporting an item, The accountant shall play it safe because the less favorable outcome. This concept allows accountant to anticipate future loss rather than future gain. 2. Consistency principle. The consistency principle states that once you decide on a accounting method or principle to use in your business, you need to stick with follow this method throughout your accounting period. 3. Cost principle. A business shall record their asset, liability, and equity at the original cost at which they were bought or sold. The revenue may change over time, e.g. depreciation of assets or inflation, but this is not reflected for reporting purposes. 4. Economic entity principle. The transaction of a business should be kept and treated separately to those of its owner and other business. 5. Full disclosure principle. Any important information that may impact the reader understanding of a business financial statement should be disclosed or included alongside the statement. 6. Going concern principle. The concept the assessment a business will continue to exist and operate in the foreseeable future and not liquidate. This allows a business to defer some prepaid expense or accrue to future accounting period rather than recognize them all at once. 7. Matching principle. The concept that each revenue record should be matched and record with all the right expense at the same time, specifically in actual accounting. The matching principle states that for every debit there shall be a credit, or and vice versa. 8. Materiality principle. An item is considered material if it would affect or influence the decision of a reasonable individual reading to company's financial statement. This concept states the accountant must be sure to include and refer all material items in the financial statement. 9. Monetary unit principle. Business should only record transactions that can be expressed in terms of a stable unit of currency. 10. Reliability principle. The reliability principle is used as a guideline in determining which financial information should be present in the account of business. 11. Revenue recognition principle. Companies should record their revenues when it is recognized, or in the same time period of when it was occurred, or rather than when it was recorded. 12. Time period principle. A business should report their financial statement or income statement or balance sheet appropriate to a specific time period. Accounting principle and debitor. A growing business can benefit from an automated accounting system such as debitor advising software. Debitor allow a business to generate and produce financial report at any given time. Additionally, it can assist you in managing your account and reporting and help determine the current financial standing of your business. Thank you.